Some retirees in 2026 may fall below this critical income line. Now, before you assume this does not apply to you, pause for a moment. Most people believe that if they are receiving Social Security and maybe a small pension, they are automatically safe. They believe the system adjusts. They believe the benefits rise with inflation. But here is the thing, there is a line. It is not widely discussed. It is not dramatic, and it is not labeled clearly in bold letters when you retire. Yet crossing below it can quietly change how much you pay for Medicare, whether you qualify for certain assistance programs, how your taxes are calculated, and even how your state views your eligibility for property tax relief. Most people never notice this until a letter arrives. Now, before we go any further, let me ask you something. Have you noticed how quickly these rules and thresholds are shifting this year? One letter, one adjustment, one small income change, and suddenly the numbers look different. If you want clear explanations before those changes affect you, make sure you are subscribed and notifications are turned on. I cover these updates calmly and early so you are not reacting after the fact. A missed update is not just information, it is money. My name is Judith Carver. I am a senior protection educator. I am not a lawyer, and this is not legal advice. This information is for educational purposes only, so you can better understand how certain financial thresholds and income rules may affect you. Stay with me. This is important. Let us begin with the first reality. There is no single income line. There are several. Federal poverty guidelines, Medicare premium brackets, tax thresholds, state-level benefit cutoffs. This is where it gets interesting. Many retirees believe that once they stop working, their financial life becomes simpler. In some ways, it does, but in other ways, the lines become sharper. For example, a retiree named Thomas thought his only income was Social Security and a small withdrawal from his retirement account. He assumed he was comfortably above any poverty-related concern. Then inflation increased food and utility costs. His withdrawals increased slightly. That small change pushed him into a higher Medicare premium bracket. He did not see it coming. The line moved quietly. Now listen carefully. Medicare. Part B and Part D premiums are affected by income through what is called income-related monthly adjustment amounts. These brackets are based on modified adjusted gross income from prior tax years. The brutal truth is that even a modest increase in withdrawals from a retirement account can trigger a higher premium. That higher premium effectively reduces your net income. And if your net income drops below certain state assistance levels, you may suddenly qualify for programs you did not realize existed or lose eligibility for ones you assumed were stable. Most people never notice this interaction. Here's another layer. The federal poverty level is used to determine eligibility for programs like Medicaid, supplemental nutrition assistance, and certain Medicare savings programs. The numbers adjust each year, but inflation does not always move in perfect alignment with those adjustments. A retiree named Linda believed she was too financially stable to qualify for any assistance. When her prescription costs rose and her property taxes increased, she reviewed her income more closely. She realized she was hovering just above a state income threshold that would have reduced her Medicare premiums significantly. That line mattered more than she ever imagined. Watch out for this. Withdrawals from traditional retirement accounts are generally taxable. That taxable income can push you into a higher bracket for Medicare premiums and federal income tax. But Roth withdrawals may be treated differently under current tax law. This is not a recommendation. It is an illustration. The structure of your income sources affects which line you cross. And crossing a line does not always mean you are doing better financially. Sometimes it means you are paying more. Now pause for a moment. Many retirees assume that property ownership protects them from financial vulnerability. Yet property tax relief programs in many states are tied to income thresholds. If your reported income is above a certain amount, you may not qualify for a homestead exemption or senior freeze program. If your income falls just below the line, you may qualify for significant relief. A difference of a few $1,000s can change your annual expenses dramatically. This is the part nobody talks about. The system does not adjust based on how you feel. It adjusts based on lines. Let me show you exactly what happened in another example. Robert and Elaine were both retired. Their combined Social Security benefits and small pension placed them just above their state's income cap for a pharmaceutical assistance program. When Elaine needed a new medication, the out-of-pocket cost shocked them. They reviewed their prior year tax return and realized that a one-time distribution from a retirement account had pushed them over the line. The following year, without that extra distribution, they fell below the threshold and qualified. The difference was planning and awareness. Now here is where it gets complex. Required minimum distributions from certain retirement accounts begin at a specific age under federal law. These distributions increase your taxable income, whether you need the money or not. That increase can affect Medicare premiums, taxation of Social Security benefits, and eligibility for income-based programs. The untold truth is that the line is often influenced by tax timing decisions made years earlier. Social Security benefits themselves can become partially taxable depending on your combined income. Many retirees are surprised to learn that up to a certain percentage of their benefits may be subject to federal income tax if their income exceeds certain thresholds. That taxable portion then feeds back into your modified, adjusted gross income, and that number influences Medicare premiums. Do not let them fool you into thinking these systems are separate. They are connected. Let us talk about housing for a moment. Reverse mortgages, home equity lines, and property sales can all change reported income in different ways. Some transactions may not count as income for federal tax purposes. Others might. The classification matters. A retiree who sells a home and realizes capital gains may temporarily exceed an income threshold for premium calculations or benefit eligibility. She did not see this coming because she believed the sale simply converted one asset into another. But for that year, the line shifted. Here is the practical question. How do you know if you are near a critical income line? First, review your adjusted gross income on your most recent federal tax return. Second, understand which programs or benefits you rely on, including Medicare, state property tax relief, prescription assistance, or utility support. Third, compare your income to the published thresholds for those programs. This is not about fear, it is about awareness. Stay with me. Most retirees do not intentionally fall below or above a line. It happens because of timing. A larger withdrawal, 1 year, a bonus payment from a pension adjustment, a small inheritance, a decision to sell investments. The consequence is not punishment, it is recalculation. Now let me give you a gentle reality check. Some retirees avoid reviewing their numbers because they do not want to feel behind, but ignoring the line does not protect you from it. Knowing where you stand allows you to make calm decisions about withdrawals, timing, and documentation. Another layer to consider is state-specific rules. Income thresholds for benefits vary widely across the country. Some states offer generous property tax freezes for seniors below a certain income. Others tie eligibility to age and residency combined with income. The line is not universal. That is why it is critical to verify with your state agencies and consult qualified professionals before making decisions. Here is where it gets even more interesting. Inflation adjustments to Social Security may increase your gross benefit, but Medicare premium increases can offset that gain. If your premium rises because of income from 2 years prior, your net benefit may feel smaller despite a cost of living adjustment. This interaction is rarely explained clearly. So what should you do? First, project your income for the current year, including Social Security, pensions, required minimum distributions, and expected withdrawals. Second, identify any one-time events that could increase taxable income. Third, consult with a tax professional to understand how those amounts affect Medicare premium brackets and benefit thresholds. Documentation and timing matter. Do not assume that falling below a line is negative. In some cases, it may qualify you for additional support. In other cases, exceeding a line by a small amount could cost you more in premiums than the additional income provides. That is why planning is essential. Let us bring this together calmly. The critical income line is not a threat. It is a measurement, and measurements can be understood. When you understand where your income sits relative to federal and state thresholds, you regain control. You stop reacting to letters. You start planning withdrawals. You start asking informed questions. If your income situation feels legally or financially complex, contact a licensed attorney, tax professional, or qualified advisor who can review your specific numbers and guide you based on your state and your circumstances. You deserve clarity, not confusion. And if this explanation helped you recognize a pattern or avoid a costly mistake, take a moment to like this video and subscribe to the channel so you continue receiving clear updates before small changes turn into expensive surprises. Then share this with a friend, neighbor, or family member who may be closer to that line than they realize. Many retirees cross important thresholds simply because no one explained how interconnected these systems really are. One simple conversation can protect someone you care about. Carry this understanding forward. Your rights do not expire with age.